When we talk about international trade risk, most of the conversation centers on buyers. Will they pay? Will they default? Do they have the credit to make good on the invoice? But there is a category of risk that is entirely separate from your buyer's ability or willingness to pay. It is the risk that a government gets in the way. A central bank freezes currency transfers. An administration nationalizes a joint venture. A civil conflict shuts down the market entirely. This is political risk. And in this video, we are going to cover what it is, who is exposed, and the tools that U.S. exporters and investors can use to protect themselves before something goes wrong. The reason most businesses carry political risk uncovered is simple. They don't know the coverage exists. They insure their buyer's ability to pay through trade credit insurance, but they have never considered what happens when the problem isn't the buyer at all. Consider a few scenarios. A perfectly creditworthy buyer in an emerging market wants to pay your invoice, but the central bank has imposed currency controls, and the payment simply cannot leave the country. A foreign government decides to nationalize the sector your joint venture operates in. Overnight, your equity stake is gone, or a conflict escalates and your entire market becomes inaccessible. In every one of these cases, a well-designed political risk insurance policy could have protected the exposure. Most companies find out what's possible only after they've already taken the loss. Political risk is not a single peril. It is a cluster of 5 distinct exposures that can be covered individually or as a package. The first is currency transfer risk, also called inconvertibility. The host government blocks funds from leaving the country, so even a willing buyer cannot pay you. The second is expropriation, sometimes called CEND, which stands for confiscation, expropriation, nationalization, and deprivation. This covers the forced takeover or seizure of your assets, equipment, or business interests by a government. The third peril is political violence, war, civil unrest, insurrection, or terrorism that causes physical damage or shuts down your operations. The fourth is contract frustration, when a government buyer refuses to honor a commercial contract or ignores an arbitration award. And the fifth is license cancellation or export embargo, when the government revokes the permits or approvals you need to complete the transaction. Each of these can materialize independently. The right policy covers the ones your specific transaction is actually exposed to. 2 categories of business tend to have the most acute political risk exposure, though the way it shows up looks different for each. For exporters and lenders, the exposure is typically on the receivables side. You're extending credit to foreign buyers, sometimes government-owned entities, and your ability to collect depends not just on the buyer's finances, but on the regulatory environment around moving money across borders. For investors and contractors, the exposure is on the asset side. You have equity in an overseas operation, a stake in an infrastructure project, a joint venture with a local partner who has government connections. If the political environment shifts, those assets can be frozen, seized, or rendered worthless overnight. In both cases, the common thread is that a government somewhere in the chain has the ability to end the deal, and standard commercial insurance doesn't touch that. For U.S. businesses specifically, there are 3 government-backed programs worth knowing. EXIM Bank, which we covered in an earlier episode, offers medium and long-term export credit guarantees that cover both commercial and political risk. If you're selling capital goods or services to a sovereign or quasi-sovereign buyer abroad, EXIM Bank's guarantee programs are often the most cost-effective political risk protection available, and they also enable your bank to finance the transaction. The second is the DFC, the U.S. International Development Finance Corporation, which provides standalone political risk insurance for U.S. investors in developing markets. DFC focuses on equity investments and project finance, covering expropriation, political violence, and currency transfer for tenors up to 20 years. The third is MIGA, the Multilateral Investment Guarantee Agency, part of the World Bank Group. MIGA operates independently of U.S. policy and can cover investments in markets where DFC has limited appetite, often adding multilateral credibility to deals in frontier markets. Impello works across all 3 programs and helps identify which one or which combination is the right fit for a given transaction. When government programs don't fit, because the business is not U.S.-based, the buyer is private rather than sovereign, or the tenor is too short for EXIM Bank to be involved, the private insurance market steps in. Lloyd's of London syndicates are the largest source of private political risk capacity globally, and carriers like AIG, Chubb, Zurich, and Berkshire Hathaway Specialty Insurance are also active in this space. Private market policies offer more flexibility than government programs. They can cover non-U.S. businesses, shorter tenors, and a wider range of buyer types. Coverage typically runs to 90 to 95% of loss, with tenors from 1 year out to 15 or more for investment-linked policies. A key feature of private market PRI is that it can be assigned to lenders, meaning a bank or financing institution can take comfort from the policy as part of a trade finance or project finance structure. Choosing between EXIM Bank, DFC, MIGA, and the private market is not always obvious, and the right answer depends heavily on the specifics of your transaction. EXIM Bank is strongest for U.S. exporters dealing with sovereign or government-related buyers on medium or long-term contracts, capital goods, infrastructure, energy equipment. DFC is the right conversation for U.S. investors placing equity into developing markets where the returns depend on long-term government stability. MIGA is worth considering when DFC's geographic priorities don't align with your market, or when the multilateral backing adds value in a frontier or politically sensitive context. For most short tenor trade transactions, selling on open account, extending short-term credit, the private market is faster, more flexible, and often the only realistic option. And for larger, more complex exposures, a layered structure combining a government backstop with private market capacity is often the most efficient solution. The key is understanding which risks are actually present in your structure before deciding who to place them with. Impello's role in political risk is advisory. We do not underwrite policies or manage your overseas operations. What we do is help you understand which risks are actually present in your transaction structure, map the available coverage options across EXIM Bank, DFC, MIGA, and the private market, and give you a clear picture of what each option covers and what it doesn't. Policy language in political risk insurance is more consequential than in almost any other line of insurance. The difference between a claim that pays and one that doesn't often comes down to specific wording around waiting periods, documentation requirements, and what qualifies as a covered act. We help you work through that before you commit to a policy, not after a loss has already occurred. Where political risk coverage intersects with a trade credit insurance program, which it often does, we coordinate both to make sure there are no gaps and no overlaps. Political risk does not give you a warning. Governments change, policies reverse, conflicts escalate, often faster than the news cycle suggests they might. The businesses that tend to be well protected are the ones that built coverage into the transaction structure before something happened, not the ones scrambling to understand their exposure after the fact. If you are exporting into emerging markets, selling to government buyers, or holding equity or assets abroad, political risk coverage is worth understanding, whether through EXIM Bank, DFC, MIGA, or the private insurance market. In the next video, we cover surety bonds and bank guarantees, the instruments that international buyers and governments routinely require before a contract closes, how bid bonds, performance bonds, and advance payment guarantees work, and what happens when they're drawn. Subscribe so you don't miss it, and if you have questions about political risk in your specific markets, drop them in the comments below.